What's up, everybody? So I was inspired to make this PowerPoint presentation on how to handle losses in trading. My name is Tanja. I've been trading for 4 years, and I want to talk about how have I been able to keep myself in the game for this long, to handle drawdowns, to get payouts with funded firms. So yeah, let's get ahead and start. So obviously, losses are inevitable in this profession. It's just the cost of doing business. No one has a 100% win rate, and all that being said, some losses are avoidable, and that's, I'm sure, why some people are here. So the biggest thing I do after a loss, I ask myself just one question: would I take that trade again, all things considered? If I would not take that trade again, I have to continue to evaluate what happened there. If I would take the trade again, there's not much to consider there, right? It's according to my model. So there are two types of losses. The first one is just a loss in the game of probabilities. You win some, you lose some, and that's just how it works. Now, the second kind is a performance-based loss based on your own execution of the trade, right? So here are some questions to ask yourself. Did you follow your trading strategy? Or did you poorly execute that same strategy? So here are some examples of performance-based losses: poor entry or exit, lack of focus, you missed the entry and then you ended up chasing, fear-based or greed-based decision making. What do I mean by that? If you widen your stop, that's a fear-based decision. If you suddenly the trade starts running up towards your target really fast and then you decide to actually change your take profit to make more money possibly, that is a greed-based decision. Revenge trading is another example where you continue to re-enter trades in hopes of making your money back right away to take revenge on the market. Another one is trading out of boredom. You don't see anything and you decide, oh, let me try this, let me try that, even though it's not your model. And last one, I do have trouble with this sometimes still, flipping your bias too much and then causing confusion and sort of feeling blinded by the market, and you don't know what's going to happen and you miss your trade, or you enter a trade that you didn't really plan out. So the next step is to make the corrections, and this is where I use something called injecting logic statements and strategic reminders. The credit goes to Jared Tendler for these concepts. I really like his book, The Mental Game of Trading. I think it's one of the best psychology books out there for trading. So essentially, an injecting logic statement is something to help ground you in that moment. For example, if you're feeling really impulsive because you missed the move and you're feeling FOMO and you want to chase, right? So the injecting logic statement there would be, my model presents itself every day. Trades come around like public buses, and if you miss one, you could always catch the next one. Meanwhile, the strategic reminder is something purely technical in that moment. What are you actually going to do in that moment? So an example is taking your hand off of the mouse, setting a limit order at your point of interest instead of chasing with a market order. Things like that. So if you want to learn more about that, I definitely recommend that book. So here's my personal risk strategy. After 2 losses, I half the risk. I go back to my regular risk only after I make back half of the drawdown. So an example is, if you are risking $500 per trade, after 2 losses, now you're down $1,000. Now you have to risk $250 per trade until you make back $500 out of the $1,000 drawdown. After that, then you can go back to the initial risk. This will slow down the bleeding on a losing streak and protect your account and your mental game as well. So this is a video I definitely recommend watching. If you made it this far in the video, I definitely recommend this video called Money Management That Works by ICT. You can find it on his channel. And these are just examples of that. That's where I got the idea from this video. If you have the risk on the drawdown, you're smoothing out the equity curve on the way down. This is an example of not doing that. Meanwhile, yes, with doing that, right? So before the trading day starts, I do recommend people evaluate yourself. Factors to consider that will definitely affect your performance. Sleep. Did you get enough sleep? Are you getting enough sleep? Are there any issues in your personal life that may be in the back of your mind and bothering you? Are you coming into the trading day angry? Do you have a mental block, perhaps from being on a losing streak? Are you feeling a little bit impulsive or maybe fearful or anything of the like, impatient to make money back? Also, I recommend know exactly how much you're going to risk per trade that day. That way, there's no quick math needed. There's no impulsive decisions that may arise, right? So, my final tips: stop thinking about the money. Rather, think about your trades in terms of your points. How many points did you make, or risk, or pips, the risk reward, or the percent risk of your account. That way, if you center the process over the money, it will take care of itself. Lastly, don't be too hard on yourself. You're already doing more than most people by actually reviewing and by watching this video. So you're already on the road to improvement. After you review your trade and yourself, move forward by using your strategic reminders. Like I said earlier, take your hand off the mouse, place limit orders, and you have to constantly reinforce this in yourself so that you develop good habits in trading and it becomes second nature. Then you won't have to think about this as much as you're trading and developing your career. So I hope this video was helpful. Leave a like and subscribe if it was, and I'll see you in the next video.